Interest rates have dropped. Will we see a house price surge in 2025? In today's episode, I'm going to unpack 3 different factors which could increase demand and therefore naturally mean that house prices surge across the country. So stick around, we've got a cracker, and I've also got a little bit of a warning at the end. There's something I'm seeing in the data which could see that the demand declines, which means that house prices may stagnate or potentially could even go down. Before we dive in and look at the data, to all the listeners out there, I just want to run through the types of people that I help on a day-to-day basis. Now, a lot of people think that property investors are greedy, but 85% of the people that I actually work with are actually first-time property buyers, and they're a little bit fed up. They can't afford to buy in the city they live. They might come from Sydney or Melbourne. I've had clients even from Adelaide, and they're like, geez, I'm never going to be able to afford a property close to my parents. So what they're doing is they're renting and then they're buying where they can actually afford. So at least they've got their foot into the property market. So, or if hell breaks loose, they can actually move into their home or at least have tenants there so that they can keep the property running from day to day while they can live the lifestyle they want to live wherever they choose to live. So when we talk about property investment, it's all about working out the right strategy for you. But it's also important to keep an eye out what's going on in the economy and the broader landscape, just to make sure that your decisions are informed and you're making the right decision for you. So that's why I'm covering today's different factors that could lead to an increase or surge in prices this year. If you are looking at buying a property in 2025 and as an investment, I've actually got a free quiz, and this is going to give you a score. It's going to give you actionable insight into what you can actually do to get yourself ready to be able to buy a property. So if you click the link below, do the quiz. It only takes about 2 minutes, and it's actually going to give you your actionable insight, whether that's financial readiness, your mindset, your knowledge, because these are really critical things that you need to have in place before buying a property. So if you want to do that, click the link below. Now, let's dive right into it and let's talk demand, right? So in economics, essentially prices go up where there's a higher demand than what there is supply. And there are some factors that could cause that demand to actually surge this year. Now, firstly, interest rates. We had successive interest rates which started increasing in 2022. And they reached a peak of 4.35%. And throughout 2024, they remained on hold. A lot of people were wondering what was going to happen, and they were even worried that interest rates may even go up further if inflation didn't get under control. Now, let's take a step back. What is inflation? Inflation is basically a measurement of the price of a basket of goods and services. So if the prices are increasing, which at one point they're increasing at about 7%, it's a bit of a worry because it means that it's difficult to afford things. So the RBA needs to increase the interest rates to slow things down, which means that less people have more money to spend into the economy, and then the economy slows down. And the good news is that the RBA has noticed that the economy did start to slow down and the inflation started to head down towards the standard sort of 2 to 3% range, which they're comfortable with. Okay, so interest rates have dropped by 0.25%, but what does it actually mean for the average homeowner? Well, if you've got a mortgage of, say, $500,000, it means you're going to save yourself about $80 a month, which is not really something to write home about. But what it meant was for a lot of people who were sitting on the sideline, worried that the costs were going to increase, it's actually given them a little bit of confidence. And we've certainly seen this over the first weekend in a lot of markets, particularly hot markets like Melbourne. I also heard in Perth and even in Queensland as well, there were more people out looking at houses, which is just crazy to think that an $80 saving per month has actually caused people to go out and look at property. But it could mean that we might actually see more interest rate declines this year if the inflation continues to head down, which if that happens, then we could see that demand is going to increase even higher. The other factor is that with a decline in the interest rate, it means that the borrowing capacity of people actually increases. Effectively, when they're doing the calculation, when you're borrowing money, they work out how much you can afford. And when the cost of borrowing money is lower, then effectively you can borrow more money. And so for people who were capped, say they were capped at 600,000, they now might be able to go out and get more money to then be able to buy a house that's within their budget. So that's number one, is interest rates. And that could have an impact on house prices this year. Let's wait and see what happens. Now, number two factor playing out is that they're looking at changing the serviceability requirements. So currently, if you're borrowing money, the lenders are required to add a 3% buffer on top of the current interest rate. So essentially, it means that there's a bit of protection in there that if for some reason you've lost your job or your income decreases, you can still afford to pay for that mortgage. And it was put in place during the COVID era just to give that layer of protection to make sure that people weren't overextending themselves. And there is talks that the government or the coalition, if they win power, they might actually reduce that serviceability requirement of 3%. They haven't said what yet, but say they drop it by 1%, that's going to have a big impact as to how much money people can borrow, which means that naturally they can then afford a higher price property. There's going to be more demand, more people entering into the market. Another change we just saw was the HECS debts. So when people are going to borrow money, if they've got a HECS debt, the government has actually now said they can exclude that out of the serviceability requirements. So again, effectively, it means people can now borrow more money. The other thing we've seen in the last couple of weeks is a lot of states are actually revising their first homeowner incentives. For example, the Queensland government just last week, they've actually abolished first home buyer stamp duty if you're buying an established property. And that's going to come to effect in the next couple of months. Likewise, WA, they've also made some changes to their incentives. They're increasing the cap on the price of a property you can buy and still get those incentives, which naturally is also going to increase demand. And a lot of other states are reconsidering and making changes to their requirements as well. So this is something that you definitely want to keep an eye out on. And the third factor, which is really causing a shortage of supply into the market, is building approvals. And the latest data from PropTrack, which has been recording this data since 2010, they're saying that right now houses are taking the longest that they've ever taken to be constructed. And this includes houses, townhouses, and apartments. They're saying that apartments are taking almost 3 years to build, whereas houses, they're taking about 13 months, which is a long time to build a house. And this has been caused by factors like a shortage of materials and equipment to be able to do it, and also a labor shortage of skilled and qualified people to be able to build homes. And it does mean that in the data, we're seeing that we're falling way short in the number of homes being constructed. In fact, in the September quarter up to last year, 2024, there are only 44,000 houses constructed, which is about 15,000 below the requirement of 60,000 to be a balanced market. With the numbers we're seeing at the moment, the forecast is that by 2029, we're going to have a shortage of over 300,000 houses. So naturally, with an increase in demand and a lower amount of supply, this is going to cause an imbalance, which means that prices are going to surge. So based on these three factors, we've got lowering interest rates, the ability to borrow more money, we've got changes to incentives for first home buyers, and then we've also got a lack of supply. These factors could potentially cause prices to really grow quite strong in some areas of the country. Now, there's always markets in markets, and there's different cities in different stages of the property cycle. But overall, this is going to naturally cause a little bit of stimulation in the housing market. However, there is a bit of a warning, and there's some data that I'm seeing which could actually impact property prices on the other side of things, and that is immigration levels. So after the country reopened following COVID, the policy of the government was to actually increase the number of people arriving to Australia. So we saw a big increase in the number of students and skilled visa entrants into the country. At the time, we were struggling to get skilled labor. I know a lot of employers that really had a tough time finding people to do the job, and we had hundreds of thousands of people moving to the country. And there's essentially almost 500,000 people in 2023, 2024 alone. But if we look at the latest data, and I'm just going to bring this chart up here, and if you're listening in, I'll talk this through for you. But essentially, you can see that the chart is starting to go down. And what this means is that the latest data, which was released, which ended in June last year, 2024, there was 63,000 people that arrived into the country, which compares to 133,000 in the previous quarter and 120,000 in the previous quarter to that. So effectively, there was half the number of people leading up to June quarter last year as there was in the previous month and also the month prior to that as well. So definitely the population growth is slowing down, which means that the demand for particularly rentals, because a lot of people are moving to the country, they're not allowed to buy a home, but certainly for vacancy rates, it meant that they went down really, really low to less than 1% in a lot of places. But now the population is slowing down. We may see vacancy rates increase, which could help rents stabilize. And I know for a lot of people, they kind of want the number of people entering the country to be at a little bit more sustainable levels so that house prices don't go crazy. Well, we may see that start to happen. And with a potential government change, if that were to happen, a different policy could also have a different impact on the number of people coming into the country. So this is definitely something to keep an eye out on. And the data is going to come out next in March, in just a couple of weeks' time. So we might take a look at that, because if we do see a further decline, we're certainly going to see an impact on, firstly, rent amounts, vacancy rates, and potentially house prices as well. Before we go today, I want to give you, firstly, a little bit of a tip. And this is something that I shared with my mum a few years ago. She was struggling with her mortgage repayments and she thought, how can I save money? And I read this thing somewhere that you can call your bank and ask for some money back off your interest rate. And effectively, she wasn't quite, my mum, she didn't really want to call the bank and say, hey, can you give me a lower interest rate? So I kind of gave her a bit of a hand, and she called up ING and said, look, I'm about to walk and this other bank's offered me this rate, can you match it? And hello and behold, within 10 minutes, a quick 10-minute phone call, she was able to save herself over $5,000 in interest repayments each year. So if you have a mortgage already, something I strongly recommend doing, even though you've got that relief from the interest rate decline, this little trick could potentially save you a lot of money. So if you have a mortgage, then something I do recommend doing. Well, great having you here today. I always like to see your comments. So if you've got any questions or comments on the things that I talked about today, pop them in below. And if it's something that's of interest, I can pop it into a further episode. Otherwise, remember to like, follow, and subscribe to the channel. We're also available on Insta. You can head to @WPropertyAdvisory, and do remember to complete the quiz. The link is below. And just to recap what today is about, today we've unpacked the 3 top reasons we could see house prices surge. That is the fact that interest rates are declining, borrowing abilities have increased, there's changes to first homeowner incentives, and finally, we're still seeing a huge shortage of supply of new houses. As always, great having you here today. Until next time, let's buy assets and work less together. All information contained in this podcast is general in nature and does not consider your individual circumstances. You should consider the appropriateness of this information with regards to your individual objectives, financial situation, and needs, and speak to a professional.